Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a moment here to go live on all the different platforms. I see some comments coming in there. We got the chat up on the screen. Feel free to drop a comment there in the chat as you tune in. Appreciate those already coming in. Tonight, we're going to be talking about how to structure blended rates for first and second mortgages. So, a great topic here to discuss tonight. And it looks like we're live on all the platforms, so we'll go ahead and get started. What we'll do is we'll take the chat off the screen for now. We'll go ahead and keep dropping comments there in the chat. You can also drop any questions you have in the chat. And after Jose goes through the presentation, we'll be more than happy to answer any questions that you drop in the chat there. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is this loan officer training where we go through an in-depth loan officer training topic. And tonight's topic is going to be how to structure blended rates for first and second mortgages. Definitely was something that's becoming more prevalent over time in the times that we are in. So, Jose, why don't you talk about how this works, why we would be looking at blended rates and sending blended rates to customers, and what we are discussing here tonight.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure blended rates for first and second mortgages. As you all know, we're having a lot of volatility in the industry, right? So there is a lot of motivation for borrowers to do some type of refinance, maybe consolidate some mortgages, some debt, some credit cards, maybe buy some additional investment properties, but definitely there are opportunities and motivation to do so, and a lot of products. And that's where we come in as loan consultants, right? Properly consulting our borrower so that they pick the lowest cost option to meet their objective. Situation that we're facing now is we have a lot of borrowers that may have refinanced in 2021, right? Maybe the beginning of 2022, and they may have 3%, 3.5%. I'm hearing even cases of 2.5% and 2% interest rate mortgages, uh, which mortgage has only been around 2, 3, 4 years, but still it's such a low rate that's going to be hard to beat. With all of the products that we have here for our HE loan as well as HELOC, but we definitely like the HE loan to combine with this because it's a more stable product. With a lower payment than the HELOC is, even if it's a fixed rate HELOC, the payment is going to be calculated differently. So for a more long-term hold, the HE loan is a great option, but you need to be able to properly break down the investment that the borrower is making, and why it would be or wouldn't be a better option, whichever may be applicable, for there to either refinance the first or keep the existing first and get a new second. So that's basically what this is about here. We're going to teach you how to be the ultimate loan consultant so that you can break it down for your borrower and, like we like to say, add value to the transaction. So what are some blended rate basics? What exactly is the blended rate? The blended rate is the weighted average of the interest rate on two or more loans. It is a calculation used to determine the effective interest rate on the combined debt. And the second mortgage is usually smaller than the first mortgage, so the impact on the total payment, aka the blended rate, is less than a new first mortgage for the total amount. And that's what we're going to break down here. So you see there are proportionate share in our pie chart where the first mortgage a lot bigger than the second mortgage. So right now we're still, I guess now we're in a volatile environment, maybe not exactly rising, but not exactly coming down. But the interest rates on those second mortgages are very attractive. They're certainly dropping a bit. And the interest rates on the first mortgage are still probably twice as high as your borrowers may have on the existing first mortgage. That's why the current rate environment may discourage borrowers refinancing out of low interest rate first mortgages. Our second mortgage HELOANs and HELOCs obviously do not require refinancing the first. That's an additional mortgage. And in adding this new second mortgage, then what we do is we proportionately calculate the interest rate, which is the blended rate, to let the customer know what their effective payment rate is. And it allows them to maintain then the nice low interest on their first mortgage, and especially allows them, if that first mortgage has been around for a couple of years, it's going to be paying a lot more interest than it did at the beginning. So you definitely don't want to lose that favorable existing amortization schedule. So how exactly do we calculate the blended rate? Now, I will let you know there are blended rate calculators, right? You can go to blendedrate.com and you have an online calculator there that you can figure this out. But you need to know the theory to be able to explain it. You need to know the mechanics of how you arrive at the number so you explain the benefits to the borrower. Because essentially you're going to be calculating the proportionate share of the interest rate for each loan. So let's assume here in our example, which we're going to be using now in the next couple of slides, our rate on our first mortgage, which is our existing mortgage, is 3.5%. And we have a balance of $350,000. And the rate on our second mortgage that we're going to be able to get, our fixed rate HELOAN product for this primary borrower, is 9.75%. His credit's a little bit not 800, probably 720, but still 9.75. And the balance is $150,000. Now, how you calculate the blended rate now is we need to determine the proportionate share of interest for each one, interest expense for each one, add those up, and then we divide it by the total loan amount. So blended rate for the first mortgage, 3.5% times $350,000, we would be paying $12,250 on the first mortgage. Beautiful low rate. Our second mortgage, HELOAN, fixed rate HELOAN, 9.75 times $150,000. That's $14,625 interest expense for a total interest expense of $26,875. Now we add up the first mortgage of $350,000 and the second mortgage of $150,000 for a total of $500,000. Divide $26,875 total interest expense by $500,000 total loan amount to reach 5.375% interest rate on our blended rate, right? So that's definitely going to be lower than if somebody were to refinance into a new loan. Best case scenario, if you're a conventional loan, maybe high fives, low sixes, depending on the credit score. And if we're talking about a bank statement loan or some other doc loan, maybe low to mid sixes, maybe a little bit higher. So definitely you're going to have higher interest expense overall, which we're going to show you in the next slide, right? But you see we're at 5.375 blended rate, so you can know now when you're sitting with your borrower or speaking with them on the phone and trying to explain to them the benefit of that second mortgage if they have a low interest rate first. This is how you can drive home the value of this transaction. And obviously in that scenario, you're also adding value for yourself. But here's where we really seal the deal, right? So in our new first mortgage, let's assume borrower 8.75% interest rate on their new first mortgage, resulting in $43,750. The blended rate we know is 5.375%, and the second mortgage 9.75%. So, does the new second mortgage save the borrower money compared to a new first mortgage? And or is it better to add a second mortgage or refinance the first? The answer is definitely the borrower will benefit from the new second mortgage, as the blended rate payment of $26,875 on that total loan amount of $500,000 is $14,625 lower than if the borrower were to refinance with a new first mortgage at 8.75. So we're assuming this is an alt doc borrower going with some type of a cash out bank statement loan to get that kind of a rate. And we're taking it to the max here, 80% LTV, we're assuming for our example. So you see big savings on, depending obviously what the objective of the borrower is, but big savings here to get the money with a new second mortgage. Now, if that's not enough, now, what are some additional considerations here? Now, that's a blended rate calculator there. That's the image of the blended rate calculator where you just input your existing first, your closed-end second. Notice it says closed-end second. It doesn't say HELOC, which a HELOC is an open-ended second, which does not have a fixed amortization schedule. And then your new first lien. That's the example that I just did. But additional factors to consider here. First one, closing costs, right? The new second fixed rate, and that's a typo, should say HELOC mortgage, has much lower closing costs than the new first mortgage, right? Because you're looking at a $150,000 loan versus a $500,000 loan. A lot of these costs are fixed and other costs are based on the loan amount. So definitely going to have some additional fees there on the new first mortgage if that's the route you're going to go. Prepayment penalties is another consideration because the first mortgage may, if it's an investment property and non-QM, may have a prepayment penalty as well, which would be another additional expense, $3, $4, $5, in some cases $10,000 additional. Now, you heard me mention amortization table, right? Now, when we're talking about the amortization table, now we're starting to really split hairs here, but this is where the loan consultant excels, right? Because you're going to bring up considerations that other application takers didn't bring up, right? Like you're going to talk to them breaking it down the amortization table. You are in Mr. Smith. You are in year 7 of the amortization of your loan. So I have here an amortization table of your loan at 3.5%. And you can see here at year 7, you're paying $550 in principal and $600 in interest, versus the amortization for the new loan, you're going to start in the very beginning and you're going to be paying at a higher rate. So you're going to be paying, this is a hypothetical, right? $250 in principal and $750 or $800 in interest. Any way you slice it or dice it, if you go from a 3.5% interest rate where they've been making payments for 5, 6, 3, let's say 3 years even, and now you're going to start again on a new loan at ground zero. So your amortization is going to be less favorable for 2 reasons. A, you're at a higher interest rate. So off the bat, it's a different principal to interest ratio. And second of all, you're going back to year 0. So now you've reset the amortization. And again, it starts where it starts. And then, with each payment that you make, it's like, $1 more to principal, $1 less to interest, or whatever may be the case for that particular amortization table. That's how the amortization tables work with every payment you make, the next payment pays a little bit more principal and a little bit less interest. So, if you bring that amortization table to the borrower, then they can visualize that and make sure that this is what they want to do. And then obviously the income considerations that may affect product selection, what may have changed in the borrower's income or employment since the last time that they applied for a loan. But I will let you know that with the He loan product, we have all those options there that you see and more. We have full doc, we have bank statement, P&L, 1099, DSCR, even we have He loans. So we have all of those options possible for second mortgages, and all at very good rates. So last but not least, there you see our happy loan consultant there did a good job of empowering his borrower with the knowledge so that he can gain their confidence and be their loan consultant for life. I mean, that's how it works in this business. You add value to the transaction, and you will get referrals, you will get repeat business, you will have a sustainable MLO career. That's the way to do it. That's the way to reach 29 years in the business, like I've been in this business, is by adding value and basically not burning your bridges, having people look to you as a resource. Even when they're not going to do a loan just yet, you want them to look at you as a resource, reach out to you for information. Maybe they're giving that information to friends and family. Next thing you know, you're getting a referral because you are such a great loan consultant. So definitely look to the mortgage calculator for all of your He loans, DSCR loans, non-QM, alt-doc, agency, and every other loan out there under the sun.
All right. Thank you, Jose. Let's see here. Let's see if we have any questions. So the question, when would you be allowed to use a blended rate versus the actual rates on the first and second lien? So it's not about necessarily using a blended rate, right? It's about informing people of a blended rate, right?
Yeah, absolutely. The blended rate calculator, or just knowing how to calculate the blended rate so you can properly explain it, whether you use an online calculator or not. It's just about exactly that, showing the customer the combined rate of the first and second mortgage that you are, the new second mortgage you're proposing, combined with their existing first mortgage. So the data that gets put in there is going to depend on, or the data for your calculation is whatever their existing interest rate is on the first mortgage, what the interest rate is on the fixed rate second mortgage that you're proposing, calculate blended rate, and then talk about their objective.
All right, perfect. I don't see any other questions, so I think we will go ahead and wrap it up. And remember that we do this show every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we go through a new loan officer training topic. So we'll be back tomorrow with a new topic. We'll see you all tomorrow at 7 p.m. Eastern time for the next episode of the Loan Officer Training Series.